I think we functioned much better without the Fed, and I think all countries would function much better without central banks.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
So is the solution to end the Fed? In your view, does the Federal Reserve need to be abolished? And if so, how would the economy function in a world without the Fed?
Well, I think we functioned much better without the Fed, and I think all countries would function much better without central banks. But if we just eliminate the Fed, and then in that vacuum, Congress just decided to take over the Fed's responsibility, and so the Treasury Department just opened up a branch. Maybe they just took over the Federal Reserve's building and basically just, changed, the logos and stuff and changed all the letterhead, but did the same thing. That'd be even worse, right? So it's like, we want to get rid of the Fed, but we don't want anybody taking over their job. So we need to return to constitutional sound money, which means we need to go back on the gold standard. And, we can even achieve the gold standard and keep the Fed, and that would be better than getting rid of the Fed and not going on a gold standard. But we need sound money, whether it's the Fed that brings that about or better just the market. I mean, the way the country ran before the Fed, we had private banks that extended credit where people would deposit their savings and it would be loaned out. There was no FDIC, there was no deposit insurance, there was a free market. So before you put your money in a bank, you did a little homework to make sure that, they had sound financials. Nobody does any homework today because no one gives a damn what the bank does with their money. And the banks know that, so they take all kinds of crazy risks because it doesn't matter. So we go back to sound money in banking. But the way money was created before the Fed is it was gold and silver. That's how the money came into existence. It was mined. You had real money. And to the extent that you issued bills, which we had note currency, that independent banks, because remember, the Federal Reserve note was originally a note. I mean, if you look at the Federal Reserve note, that's what it says, right? A $5 bill, it says this note is legal tender. It doesn't say this is $5. I mean, it has the word $5 written on it, but it doesn't claim to be $5. It claims to be a note because that's what it used to be. It used to be a note that obligated the government to pay you $5. Now, what was the $5 that the government was obligated to pay? It was gold. That's what it was. Or in some cases, it was a silver. They had silver certificates and they had gold certificates, but they were promises to pay real money. Where'd the real money come from? It was mined. So the government just couldn't create paper out of thin air. If they wanted to issue paper, they needed the real money, the gold, to back it up. And it was the gold or the silver that were the dollars. The Federal Reserve notes were the notes that entitled the bearer to receive dollars. And now initially those notes were issued by private banks and then they were issued by a central bank. But the central bank was initially designed to be private. It's not part of the government. It was just a central bank that was chartered by the government, but it was owned privately. It was operated privately. And the reason for that is that constitutionally, the U.S. government couldn't do what the Fed does because the U.S. government doesn't have the authority to print money. They can't issue paper money, even if it's backed by gold and silver, because the only thing the Constitution says the federal government can do is coin money, not print it, coin it. So what does coining money mean? That means taking money, gold and silver, and making it into a coin, which is what they used to do. They had a United States mint. In fact, we still have a mint. All of the paper bills are printed by the Federal Reserve, right? Or the Fed issues those notes. But the U.S. Mint makes the dimes and the quarters and the nickels. The Fed doesn't make those, right? But the problem is there's no real money in those. There's just a bunch of copper and zinc in there. Mostly zinc now. They don't even afford the copper. But we got to go back to sound money. And then if we do that, then we rein in government spending. But the biggest enemy of sound money is the government, because the government doesn't want to be disciplined by gold. They want to just be able to buy votes by creating inflation. And if we have to have sound money, they can't do that anymore. If they want a new government program, they've got to pay for it. and they've got to tell the voters, hey, if you want this from government, here's what it's going to cost you. Because if the politicians have to tell the voters what this free stuff is going to cost, they're not going to want it because they'll know it's not free. They only want the stuff because they think they don't have to pay for it. The politicians want to keep lying to the voters to get elected, so they don't want to be on the gold standard. But the public should demand a return to the gold standard just so we can rein in the excesses of government. But again, to do that, a lot of people are going to have to come to terms with the fact that they're not going to get the money they've been promised. People aren't going to get all their Social Security benefits. They're not going to get their Medicare benefits. They're not going to get their pensions because the government doesn't have the money. Now, it's not like there's a way to pay all this because the government doesn't have the money. So either we do it the honest way or the dishonest way with inflation. But inflation is the path that we're likely to go down because it's more politically expedient, which means everybody gets their money, but their money doesn't buy very much. You lose it to inflation. And that's already happening. And everybody is complaining about the big price increases. This is all the result of government spending and deficit spending. This is how you're paying for government. So when you go to the grocery store and you get mad at what things cost, get mad at the government, because the government is the reason that the prices have gone up so much and now everything you need to buy is so expensive.
What are your thoughts on the summit, and do you think we will eventually see a BRICS currency?
Well, either the BRICS will unite around a common currency, which is backed by gold, or they'll individually back their own currencies by gold. But I think one way or another, they're going to a gold standard because that's the only real legitimate way to replace the dollar. Right? You need to have an anchor. You need to have something underpinning a monetary system. Now, initially, it was gold. All the world's currencies were backed by gold. Then the United States, through Bretton Woods, convinced the world to use the dollar instead of gold. But with the promise that the dollar was as good as gold because it was convertible into gold on demand at a fixed price. And so if you held dollars, you held gold. But it was better than gold because you could take those dollars and loan them to the US and buy treasuries and earn interest, yet be able to get your gold whenever you wanted it. So it made sense. The world would hold on to our paper. But when we went off the gold standard in 1971, the dollar plunged, interest rates went way up. So when we no longer had gold backing, we had to pay higher interest rates to get people to loan us money because they knew that there could be more inflation. But the dollar, even though it was backed by nothing, continued to serve as, the reserve. Well, that was also when the US government was a wealthy creditor nation. We had the world's biggest trade surpluses back in the early 70s. We were the wealthiest creditor nation. And so, it made sense. Also at the time, the Soviet Union was very powerful, superpower. And so the US was kind of protecting the world from this superpower and the threat. And a lot of people kind of needed our protection from the Soviet threat. But none of that exists anymore. The US is the world's biggest debtor nation. We're broke. We owe more than all the other debtor nations combined. We're running massive trade deficits instead of trade surpluses. So nobody needs our money to buy our stuff because we're not making the stuff. We're buying the stuff that everybody else makes. The Soviet Union doesn't even exist anymore. And Russia is a shadow of what the Soviet Union used to be. So you don't have that big threat. People say, well, what about China? China is not a huge military threat to the world the way the Soviet Union used to be. And so people don't need America's protection right now. They don't need the dollars. And we just showed them how dangerous it was to be beholden to the dollar through the sanctions of Russia. And so we've told the world, if you hold the dollar, we got you by the short hairs. And if you do something we don't like, we're gonna punish you through the dollar. And so countries don't want to be in that vulnerable position. They want to divest and de-dollarize and extinguish that threat. So that's just another reason to do what they should be doing anyway, because the cost of subsidizing American profligacy is a burden that the world's been bearing. These trade deficits are expensive for the world. I mean, it's great for Americans because we get to consume without producing, we get to borrow without saving, and we get to live a standard of living that is higher than what we would be entitled to if we had to live off of our own productivity. The flip side of that is that the rest of the world has to agree to live beneath its means, to produce stuff and not consume it, to save but not borrow as much. And basically, they're sacrificing to, enable this whole system to continue so that we can keep printing money to buy stuff that we didn't make and can't afford. But when that system ends, it's a huge relief for the world that's been supporting it. And so they're going to see a commensurate rise in their living standards as Americans see a big drop. So I think that the BRICS have an incentive to do this. It doesn't make any sense. I mean, what other country is going to be the reserve? I mean, first of all, they're not going to use the euro. They're not going to use the yen. I mean, Japan and Europe, they're not even part of this. But they're not going to say, let's make it the Chinese yuan or the Russian ruble or no. None of those are going to work. The only thing that works is gold. And gold works beautifully, and they know it. And so gold is going to be the common form of money that all these countries ultimately adopt, whether they create a new currency that's backed by gold or just back their existing currencies by gold. That's where we're headed, I think. But I also think a lot of U.S. stocks are too expensive as far as the PE, and their earnings are going to be pressured through inflation and rising interest rates and taxes, that even though you won't lose as much over the next 30 years, let's say if you're in the S&P, as you will if you're in bonds, I still don't think you're going to get a real return that's going to beat inflation. I don't even think you'll come close. You'll come closer than you will with bonds, but you're not going to come out a winner. I think if you have a long-term time horizon and you want to beat inflation and you want to have real positive returns where your money or the portfolio delivers more purchasing power in the future than it would have if you just spent it all today, right? Instead of investing it, because that's the whole point, right? That's why we're investing our money, so we can grow it. And then we over time, we can consume more than if we just spent it right now. I think you've got to have a inflation hedged portfolio that, to me, is going to be a globally diversified portfolio that is predominantly outside the United States, outside of the blast zone of this complete economic implosion. Yes, the shock waves are going to be felt around the world, but it's going to be greatest here at the epicenter. So you get further away from it, yeah, you'll feel it, but it's not going to devastate you. And if you look at the global stock market, the valuations are much better. You're able to buy stocks at much lower PEs with much higher dividend yields in countries that are going to end up being the winners from a global realignment of this, pecking order, where right now the U.S. is on the top. Now, I don't think in 10 years the U.S. is going to be on the bottom, but we're going to be a lot closer to the bottom than the top when it comes to per capita income or living standards or stuff like that. So you want to invest in the countries that, they're going to have a relative markup on their assets, on their currencies, where the people are going to have higher, not lower standard of living, certainly in relation. And at one point, the American standard of living was so much higher than anywhere else in the world, it wasn't even close. And now, you have a lot of countries that have a higher standard of living than we do now. I mean, we're still pretty high, but a lot of that is because we can survive on debt and exporting our inflation to the rest of the world. So this whole thing is going to collapse. But you want to have assets in countries where those assets are going to appreciate relative to the U.S. And you also want to have exposure to the emerging markets, I think more so than you might have had in the last 10, 20 years. The emerging markets, to me, are super cheap in relation to developed markets, and foreign developed markets are cheap compared to the United States. So emerging markets are super cheap. And those currencies probably have the most room to gain as the dollar falls. So you want to be there, and you want to be in a lot of resources. You got to realize that the world has underinvested in the capacity to produce real resources. And so you want to be invested in energy, whether it's oil and gas or other alternative forms of energy, other raw materials, metals. To the extent that we use less oil and gas and more electric, well, you need copper, you need nickel. I mean, you can't make those batteries out of paper, and even paper would mean you need trees. So you still need stuff. And so I want to own the stuff. Agriculture, I think, is going to be in increasing demand. So, we have exposure in our portfolios and in our funds to all the sectors that I believe you need to own. And you want to get out of paper into real things. You want to own companies that own real things, not just pie in the sky story stocks that are hyped up, right? That are all sizzle and no steak. Maybe there's a tech stock that does have something, but if it's trading at 50, 100, whatever times earnings, or the companies that don't even have earnings, they just trade at a multiple of their revenue. Those are not the kind of stocks that you want in a high inflation, rising nominal yield environment. Those were the stocks that worked when we had ZIRP, but we're not going back there. A lot of people think we are. We can. It's like, Dorothy, couldn't go back to Kansas. Well, we can't go back to that Oz reality of 0% interest rates. It's just not going to happen again. Europe's not going to go back to negative rates, not in nominal terms. I mean, everybody's got negative real rates, especially if you use an honest inflation measure. But we've awoken from that stupor, and we're not going back. People just don't get that. That was just a one-time aberration that lasted a lot longer than it should have, but it's over. And the new reality is going to be high inflation, rising interest rates, falling bond prices, falling asset prices. And during that 0% interest rate era, the US did the best. US stocks by far outperformed everybody else. So as the air comes out of that bubble, it's the US stocks that are going to be the worst performers. So you got to get out of these assets.